Welcome back, everyone, to the Risk Intel podcast, powered by SRA Watchtower, where we share risk intelligence with experts from across the banking industry. I'm your host, Ed Vincent, CEO at SRA Watchtower. Welcome back to the Risk Intel podcast. I'm very excited to have two special guests with us here today, Dan Bailey and Eric Bonnell. Dan joins us having worked in the financial institution industry for many years, most recently as the risk officer and built out a risk program there. Eric, similarly, you stepped into a $13 billion institution, fairly recently and went through that same journey. So we're really excited to hear a bit about both of your journeys today and learn about kind of how you went about setting up risk programs in both of those instances. Before we jump into it, though, Dan, perhaps you could kick us off with a little bit of your background, and then Eric, you do the same, and then let's get into the meat of the content.
Sounds good, Ed. Thank you. Again, my name is Dan Bailey. I am the owner and managing director of Certified Risk Partners, a consulting, advisory, implementation risk management firm, and we have a lot of things going ahead of us, I think, here. So I'm excited about that. But as you said, Ed, I walked most recently in our institution, based in there, and within the first year. What the FDIC told us was we had accomplished more in 1 year than they'd expect most banks to do in 2 years. So very, very honored by that comment. It was absolutely a team effort, though. Certainly won't take any full credit for any of that in particular, but certainly was privileged and honored to lead the team there. Eric?
Thanks, Dan.
So hi, I'm Eric Bonnell. I'm the Director of Enterprise Risk Management for First Financial Bank in Abilene, Texas. So it literally is the Wild West. $13 billion bank that grew up really quickly, organically, mostly with PPP loans, went over the 10 billion mark.
Let's unpack perhaps both each of your respective journeys here. Eric, let's stick with you, and then Dan, we'll circle back around. Right, you said you walked in the door there, Eric, and the DNA was good, right? There was a culture of risk. Why then did they feel there was a need for you to even join the party to start?
Well, as most things happen at banks, the regulators wanted an ERM program. That's the starting place. My goal, though, is not to just be a check the box, right? It's to come in and add value. So while we're looking at, again, making sure we document our work, show our work, if it never is documented, it never happened, that kind of thing. It's also tying into the project management process and understanding business change management, how regulations change. Are we doing the right things? How does certain crisis situations impact liquidity is a big thing for the Federal Reserve that we've just moved to from the OCC this year. It's all about linking things together. Our fraud group is phenomenal. That's the best part of operational risk at this bank, and that discipline is what I hope to do, at the bank.
When you, Dan, when you walked in the door, what did you encounter in terms of the risk culture inside the organization?
Maybe a little similar to Eric. I think there were aspects of the DNA, associated to risk management, but it was very much pointed in the direction of the financial risk pieces. So kind of in their DNA. So let me kind of set a table for this particular bank. They are a commercial chartered bank. So they're one of 12 to 15 in the country. And it was my first experience to work directly with a commercially chartered institution. And so most of what they do, practically all they do, is in that commercial space. They don't do much in the realm of consumer. So they had no issues with being a sole lender on a $500 million, $750 million loan, commercial loan. So kind of in that DNA that they had in particular, they were tracking really well their liquidity. They were tracking really well their interest rate risk management. But the problem is, and to the point Eric just made, the regulators come in, especially once they crossed that $10 billion threshold. It was literally within an 18-month period, they went from 7 to 8 billion to close to 40 billion at one time.
Wow.
So that got the regulators' attention. That happened to be right around the time of Silicon Valley Bank, Signature Bank, First Republic, and all of the debacles that happened there. So the regulators' radar was on
Yeah.
15 out of 10, you know, kind of
Yeah.
from that perspective. So the regulators came in, and the bank wasn't monitoring liquidity risk and interest rate risk sensitivities the way that the regulators expected them to. So that was kind of a gotcha, if you will. And so that's one of the reasons we came in. They were able, as a community-sized bank, a community-sized institution, to kind of slide by without a formal ERM and the underpinning programs officially, right? They were doing some of that, but all of a sudden now, no, we have to make it official, and that's one of the reasons my boss and I were brought in, was to just, you know, formulate, design, implement, and then start that maintenance process.
So I'm gonna go. I'm gonna then kind of take us through a little bit of that journey, if you would, Dan, and then Eric, I'm gonna come and ask you that similar question, right? There was interaction with there was some regulatory encouragement, let's say,
Yes.
that this would be a good thing for the institutions to do, right? It was clear that the scenarios, the sensitivities, right, those weren't being fully, evaluated necessarily. So there's some risk there, right? So there's plenty of reasons now to say, okay, we're going to lean into this. When you walk in the door, where did you start, Dan?
So we did start with that enterprise risk, framework. We thought, the most appropriate thing to do was to build your foundation. A lot of times what I do, my wife's an interior designer, so I use a lot of construction analogies, because she does a lot of renovations and remodels in her business, in her interior design business. So I use that construction analogy to say we've got to make sure we lay the right foundation first. The way I view things, I think, is the way a lot of people tend to view things, is you have standards and principles and practices that are solid, that are part of that foundation, but you don't know what the plan looks like until you do your CAD two-dimensional drawing, looking from the ceiling down to see how is that foundation laid, and then how can I build the walls and everything else up from there. And with every institution, that's different. There's no one size fits all. So the ERM program was the first, the framework on that was really our first task. So we got to define what is risk management, who is responsible, who owns it, throwing together the three lines of defense structure, and making sure that that's clear and understood across the organization. And from there, what underpins enterprise risk management as more of an umbrella type situation. So then we took that, and I started also hiring a team and building out some operational risk management pieces as well. But ERM, to your question, ERM is really where we started in that framework.
Eric, how about your journey, right? Where did you start, right? To Dan's point, right? Where do you begin?
I started with the risk appetite state. So what we did was I went to the 10K, and I went to other places where there were risks articulated, and mapped them to the different, I call them the 7 domains of risk, right? So we had, for example, operational risk. You have different aspects of operational risk, understanding the risks within that realm, right? So model risk, legal risk, IT, cyber, all of that, right? Transactional risk. built out a framework, put that aside for my RCSA. We'll talk about that a little later, but made sure that those risks were articulated in our risk appetite statement to say we go to a moderate level of risk appetite for operational risk because of these things, and we feel we are mapped pretty well to that, right? And we're within that appetite. What I found here at this bank is the financial appetite is very conservative. We're very good with liquidity and whatnot. So it was a hard sell on the financial side why we're doing this, but I was able to show that we were successful on the financial side by doing this. And I think that caught their attention. And now from there, once I had the risk appetite statement together, then it was building the different aspects of the program. So my framework of risks below part of the ERM risk framework is a framework of risks, 7 domains of risk, 3 levels down, right? So operational risk has transactional risk, cyber, several others I mentioned, legal, model. For each one of those, I have mapped out the key risks: failure to do this, inability to do that, and it leads to that type of risk, operational risk. Now what I have is a framework that I can use to engage my my audience around GRC, right? So I was able to get to pull out their controls and pull out their what does separation duties mean for wires, and we built that into the program. So started to put issue management in place as well. So when specific situations arise, or we find that somebody raises their hand and says, "Hey, I think this isn't as good as it should be. What can we do?" We put an issue in, self-identified or otherwise. If it comes from an event that happened, well, why did it happen? What was the root cause? And we map those to the risk assessments. We put action plans together, and we show our work on how we fix those things. So that's the second component, along with the RCSA. And then for next year, it's moving into I mentioned that the Fed wants to understand how operational events map to liquidity. How does it affect liquidity, and are we good in that area? So mapping these risk domains to each other, to me, is something that's called business resilience. Business resilience is making sure that the operations are sufficient to manage the risk. And if you have risk or a crisis happens that's out of your control, you know what you're going to do. So it's bigger than BCP. It's bigger than incident response. It's everything, right? So that's my next maturity, is to get people thinking that way and bringing that to new products and new projects. When we put a new project, a new piece of software in that touches models, how does that affect the liquidity? How does that affect the market, or decisioning process for UDAP or whatever it should be? So
you used a phrase there to get people thinking that way, and Dan, you made a comment about getting the 3 lines of defense in place, right? Both of those have implications that this is not something that you are going to be able to accomplish on your own, right? You need to bring your stakeholders along with you. Are there any observations that you'd make around how do you bring the organization with you? How do you get those stakeholders to buy in and take this journey together with you?
So I would say yes, and the simple word is partner, right? And that's one of the reasons, I chose the name of this company that I've started, Certified Risk Partners, and my tagline is, "We're partners, both a verb and a noun." That's my tagline for this organization that I'm doing. And it's because I believe that much in partnership and the value of it. And the fact is, we can't do anything by ourselves. we're always going to have somebody that is either leading us, that we're working alongside, or that we're leading, and so there's so many benefits of understanding the true word of, being a partner, or, what all of that entails, if you will. And it's really making sure, in a simplest analogy, if you will, is that we're all in a boat and we all have an oar. Are we rowing in the same direction to the same destination?
Right.
And the leader is going to cast that vision to understand what that destination is. And whether that's the CEO or whether that's a team leader or anybody else within the organization, that's kind of the essence of how I do my best to try to bring people along. Look, I'm in this with you. I understand risk, maybe, as far as risk management, I understand that may be better than you do, but I don't understand what you do better than you do. So Can we bring that together? Can we create this cohesive perspective that enables us together to identify the risk? And then once we identify it, let's measure it. Once we've measured it, let's mitigate it. And then once we've mitigated it to an acceptable level, now we got to monitor it. So I'm a big fan of IMMM as a bit of a concept for risk management.
Yeah. Thanks, Dan. Eric, any observations you have around bringing people, getting them into the boat with you?
Well, to continue the boat analogy, somebody better say, did anybody consider that rock that's right in front of us? That's the risk manager. And then the people rowing have to row in the right direction. So I see it. I totally get the partnership. That's exactly right. I think sometimes the risk manager takes a role of coach or therapist. I wrote this in one of my recent articles. It's going through the Kubler-Ross stages of grief. They don't know what they don't know when they start, right? And then they see that there's a problem, and then they get depressed and they bargain. Well, maybe if I only do this much, it'll be okay. That whole process, bringing people through that process, is risk management. By definition. You hopefully educate people by doing that, by having them go through these processes. So this business change management function that I put in place to tie in with the project management and the product management functions, I'm inserting myself into that process. That's where I am now. And most of my day is spent in Excel writing RCSAs until I get my tool up and running. But I really want to be out there and talking to people and getting them to understand what risk is.
I'm going to we're going to come back to that conversation about tooling in a few minutes here. But let me ask you. You talked about one obstacle might not be the right word, but one important characteristic there of getting people to take the journey with you. Are there any other key obstacles that each of you encountered when you stepped into these roles, and as you went through this journey that folks should be aware of, and perhaps any lessons learned from that you would do differently the next time around?
There's the check the box that always is there because the Fed. But while we're doing it, why don't we do it in a good way that we're able to manage it, and we're able to have a team that can support it, not just make it through the day like we seem to do, right? We make it through the day, do our transactions. I've got to get that out to the customer. Very important. But what if we could do it better? What if we could do it more automated? What if we could take some of that tediousness out of that process, and you can move some of it into these other processes, which actually will. It's like when I just had shoulder surgery 2 weeks ago, and my arm is healing, and I want to move it around the way I want to move it around, but I can't. Right. I have to be methodical about it. I have to do it in the right way. I have to build the muscle memory. I have to get the strength back. I'm not where I can get the strength back. I'm building muscle memory now. And that's where I am with my bank now in terms of the discipline, risk management.
Yeah. No, that's a great analogy too with your shoulder, Eric. And having had a knee replacement, I have some level of understanding. And you're right, the process of healing, can be very similar to the process of, let's call it, getting people on board, getting people to understand, kind of what's going on, because we are kind of coming in and doing a little surgery on the organization, right? In a lot of what we do. We're digging in and we're trying to find those areas to just root out. We're trying to remove all of the bad stuff, so to speak. And then once we do that, and there's still not a clear understanding of the best way to do something, because again, different organizations, it's going to be very different. No one size fits all, but just understanding the best way to come alongside of them and just help them do their physical therapy, so to speak, in and around all of those areas we've rooted out and kind of hopefully are in the process of making so much stronger, right? 6 years separated from my knee replacement surgery. I recommend it to anybody, but I have to tell them, do the pre-work, do the post from a physical therapy perspective, because you got to be prepped, you got to be ready, and you got to be strong to be able to let your recovery be the best it can be once you've had the surgery. Kind of in that same vein too, there's the coaching and the mentoring that we're doing. So not just being the surgeon, but we're also being that coach and mentor. We kind of wear a lot of hats. And when you were talking about the stages of grief and all of that, yep, you play therapist. I think you mentioned that. There's so many roles that we play. And I don't know that any one of us can play all of those roles effectively. That's why we need our teams as well. Now, there's a couple of different ways to go about that. And, starting this new firm, sorry, I'm not making shameless plugs, I promise. But starting this opportunity, I've done 10 years of consulting in my career, and I know the value of bringing some people in from the outside with a fresh set of eyes that can really kind of help us reshift maybe the focus or just turn our head this way just a little bit to look in a different direction. I think that's extremely important to bring in people who complement maybe our own weaknesses or the things that we can't do all of it as an individual, right? So to me, that's a huge piece of everything that's going on there. So
with this concept that you need resources to accomplish these outcomes, right? Whether that is right getting a budget and getting an internal team, bringing in some expertise from the outside, Dan, that perhaps complements some of the internal strengths or closes the gap on some of the weaknesses. How do you measure success along this journey so that you can go to your board risk committee, to your CEO, to your CFO, to say, this is a journey, right? Eric, you mentioned it before, right? You took us through kind of the first year, the second year in that, and the third year where you're going right towards business resiliency, right? This is not a quick fix. So you need to be able to, I imagine, demonstrate success along the way so that you can go and either secure budget or maintain budget along the way. Are there ways that either of you would point out, or each of you would point out, measuring success along the way that helps you, reinforce that business case? Eric, maybe we'll start with you.
Well, I'm all about teaching them about return on investment. That's the other piece of this, is if you know your risks and you're able to mitigate them in your business plan for your projects, then you have some meat to put return on investment against and show value. But in terms of how I'm trying to, so right now, this side of my brain is ERM and this side of my brain is ORM, and I'm it.
Yep.
That's it. I had a conversation with my board members we're all about the key risk indicators and understanding how we can make them better and how we can automate processes better. Yeah, it's all about return on investment and making sure that whatever you put in place, then going back and did I meet that return on investment? And then you build trust and your word is, what it is. So hopefully if you build trust by showing that, they'll trust you next time and be more open to resources.
Yeah.
No, I agree. The return on the investment can be huge from that perspective. Very valuable tool, and in its own right, I think tying into that is proving out that what we are building has the most efficient approach possible, right? Because the efficiency is going to have a greater benefit on that return at the end of the day. So if we're building things in as efficiently as possible, which may mean we've got to invest in technology rather than people. I know, I'm trying to be a straight man too into the conversation about tooling, right? So at the end of this, the reality is I've seen where adding technology versus human resources really better enables a faster, more appropriate return on the investment. And using technology gives you the ability for repeatable processes. So you get a wash, rinse, and repeat over and over and over again because the machine's doing it the same way. The easy thing to figure out is when you realize you need to tweak part of the process inside the machine, you go and do that, and it's going to wash, rinse, repeat again. And gives you probably another easy way to measure what that return might look like. But I'm always a fan of, I don't want to go to the Terminator stage of, how much AI is going to benefit us because I don't want the machines to take over. I always feel like the human gut check, there's nothing like it. There's discernment in it. There is wisdom in it that machines, I'll say at this point, who knows if they get there, but the machines can't supersede that.
Well, I like the way you characterize that, Dan. That there is a role for technology, right, for the wash, rinse, repeat cycle. But then there is a moment where perhaps that cycle needs to be adjusted a little bit, right? And whether that is the gut check, the intuition, the discerning perspective. There's someone that needs to adjust those dials. And yes, maybe that moves beyond us at some point in time, but certainly at this stage of the game, having expertise involved when you're turning those dials feels like a really valuable input into getting the most out of that technology. So you do in fact get the efficiency gain. You don't get technology that's going to cause you to have to repeat the process again because you didn't use the technology particularly well.
Right. Absolutely.
I'm going to. We've covered a lot of ground here, and I greatly appreciate both of you sharing a lot of thoughtful insights. I'm going to try and recap this a little bit, and then we'll bring this session to a close, and then I'd like to pick up in our next session this conversation about tooling, because I think that understanding your respective experiences on how you went through that process of evaluating and selecting. And then embedding tooling is also incredibly valuable. But I think that if I look back at the conversations here around what you encountered when you walked into organizations, there was some outside encouragement to lean into ERM and then getting in there and having a starting point of building the foundations first, starting with a risk appetite statement, getting your base in place. And then building from there, bringing stakeholders along the journey, right? We talked about getting folks in the boat, all rowing the same direction, and really partnering with the organization. And then ultimately getting those stakeholders who are controlling resources to get behind you as well. Eric, I love your example that you shared there of going to the board and really articulating what it takes to create one of these KRIs, right? They have to, I'll say, feel the pain, but really understand and appreciate the effort that goes into it. And then multiply that out by however many KRIs you want to track. And there's an appreciation that than for the value that these ERM functions are bringing to organizations. So a lot to digest. Greatly appreciate all the thoughts, and we look forward to picking up the conversation with you guys on the tooling front in the next episode. Thanks, Eric. Thanks, Dan.
Thanks.
Thanks, Ed.